Good morning, good afternoon, and good evening to our guests. Welcome to Invest Africa's 2026 East Africa Outlook webinar, the third one in our series this month. I am Chantal Carrington, CEO of Invest Africa. With Invest Africa being a leading platform to drive capital from the capital hubs to Africa, we will be unpacking the region's economic and risk outlook to keep our network informed as they navigate investment. Today, we will look at how East Africa continues to lead the continent's growth charts. We'll discuss the structural drivers and headwinds shaping this high-growth region, with a focus on infrastructure that's leapfrogging with significant investment in roads, rail, ports, energy, enhancing inter-regional connectivity and trade flows from Ethiopia to Kenya to Tanzania. Also agri-tech and value chain transformation with a youth-rich workforce and rising middle class and a growing push toward modernizing agriculture, agro-processing, and export-orientated manufacturing. We'll look at energy transition and renewables, with the region having one of the strongest cases for low carbon investment, geothermal, hydro, solar, and regional power pooling initiatives. And last but not least, the managing of debt and macro imbalances. The growth trajectory is favorable, but several countries face elevated public debt, currency pressures, and governance challenges. Now, Jason, we are keen for you to share your expertise with us by leading the conversation on how East Africa can capitalize on its demographic, infrastructure, and connectivity to strengthen its position as a global investment frontier. So over to you for introduction and to welcome Hutch and Hajila. Thank you.
Thank you very much, Chantal. Good afternoon, everybody. And for those in other time zones, good evening and good morning. My name is Jason van der Poel. I head up the project development and finance practice at law firm Webber Wentzel. Webber Wentzel is an African firm founded in South Africa more than 150 years ago, and we provide in-depth legal and tax services through the continent in alliance with Linklaters and a network of deep relationships with Africa's leading law firms. As we open this dialogue on East Africa in early 2026, just a couple of weeks old, the data tells us a compelling story. We're looking at the single fastest growing economic bloc on the continent. The headline numbers are undeniable, and while global growth remains sluggish, the East African community is projected to expand by roughly 6% or even more this year. Kenya, Tanzania, Rwanda are not just surviving the traumas of 2025 as we all try to cope with them. They are in many ways defying them. But we know that GDP is just a headline. It's not where the rubber really hits the road. And that's what we're here to talk about today. We know that East Africa can be described as having two speeds. One is the positive story of the structure, where Tanzania is emerging as a resource giant. Kenya is seen as a tremendous transport hub and a hub for digital services. DRC in the East Africa community is a very important part of the supply chain. But then there are also some strains in the East African area, and that would include things like the cost of capital, political maturity, Generation Z, demographic really growing and playing a major role. So the question isn't, is East Africa growing? We know that it is. The question is it investable and how? So with that, I'd like to introduce our two speakers. First, Robert Hutchinson, who we'll refer to as Hutch. Hutch, I believe that's your preference. Hutch is based in Nairobi, Kenya, and specializes in working with business leaders and investors on matters relating to emerging and enterprise risk, business resilience, and crisis management. He works with organizations to be more secure, resilient, compliant in their local markets. And by way of interesting facts, Hutch served as a commissioned officer of the British Army for 10 years. So we had better behave ourselves. And following his time in the military, Hutch was a risk and business intelligence team for a FTSE registered extractive company in Tanzania, worked at PwC, and also recently was a managing partner of Control Risks East Africa. Hutch, delighted to have you on this panel. And then secondly, I'd like to introduce Hajila Padachi, senior economist at Mauritius Commercial Bank and a proud alumna of the University of Cape Town, as am I. True Africans, I think. Hajila leads the global and regional desk within the Strategy, Research and Development Unit at MCB, Mauritius Commercial Bank, and she guides the bank's analysis of African markets, keeping senior management and business lines informed of emerging trends and risks. In her role, she helps steer MCB's approach to Africa's diverse markets, highlighting opportunities, anticipating challenges, and supporting long-term forward-looking growth ambitions. I didn't know this, but Mauritius Commercial Bank was founded in 1838 and is possibly the oldest commercial company and one of the oldest banking institutions south of the Sahara. So I found that super interesting. Before I hand over to our esteemed panelists, I'd like to just go through some fast facts on East Africa. The first, which countries constitute East Africa? Depends on which way you're looking at, whether you're looking at the East African Community or the United Nations geographic definition. So the East African Community has 8 partner states: Burundi, DRC, Kenya, Rwanda, Somalia, South Sudan, Tanzania, Uganda. I think I've got all that right. DRC is a member of the EAC, although geographically it's considered part of Central Africa. Then the UN geographic definition has about 20 countries and territories, including the Horn of Africa, Djibouti, Eritrea, the ones that I mentioned already, and the Indian Ocean island nations, Comores, Madagascar, Mauritius, which is where Jila's based, and Seychelles, and then Southeast Africa, including Malawi, Mozambique, Zambia, and Zimbabwe. So I thought that was an interesting distinction. Another fast fact: what is the size of the population of East Africa, and what are the main demographic splits? Depending on whether you're looking at the East Africa Community or the UN definitions, it's 520 million people or 510 million people. The key population centers are in Ethiopia, DRC, Tanzania, Kenya, Uganda. In terms of the main demographic splits, we've got a youth bulge. The median age is 18 to 19 years old, compared with 38 years old in the US and 48 years old in Japan, a much older population. The youth population is roughly 70% of that population is under 30, which creates a high dependency ratio, but then also offers a massive potential labor force for the future. There's a very rapid rate of urbanization and a rapid growth rate of the population. What are the predominant industries of East Africa? Agriculture, cash crops for export, subsistence farming, services and technology, which are a real growth engine, fintech, mobile money, telecoms, tourism, emerging industries, oil and gas, with Uganda developing its oil fields, with Tanzania developing LNG, Kenya with its oil deposits in Turkana. The region is a green energy leader, with Kenya generating over 90% of its power from renewables, predominantly geothermal and hydro, but also wind. Ethiopia has a lot of hydro. What are East Africa's predominant exports? Copper, precious stones and metals, coffee and tea, mineral fuels, ores. So I'll stop there, having set that scene with some of those fast facts, and I'm going to pose the first question to Hutch. Hutch, as an African security and risk expert, please could you set the scene with what you're seeing in the advice you're giving every day on a day-to-day basis to your clients around East Africa in the global context?
Jason, thank you very much. Hajila, really good to be on the panel with you. Guests, wherever you are in the world or listening when it's played back, thank you very much for joining us. Jason, first of all, I think as part of that conversation, it's really understanding where East Africa sits in the global macro environment. I'll list a few things that are going on in the world. And I think under the theme of unnorming norms, what is going on, it's pretty difficult to scratch your head and think it's just the 20th of January, 2026, and not the 20th of December as we head into a Christmas, having had a bloody long year behind us. We've got a very long year ahead of us. So just a few things that are going on in terms of unnorming norms. We have the USA, and we have Donro, we have Venezuela, we have Greenland, we have China, we have Taiwan, and that we have European unity regarding NATO, we have European unity regarding Ukraine, we have European unity regarding Greenland. We have Iran, we have Palestine, we have the GCC, we have Sudan, and we have Yemen. We have continued conflict in DRC as well. That's a shortened list of what I could provide as of January the 20th, 2026. So there is a lot going on. So I think in terms of the competition for airtime, resourcing, capital, attention, bandwidth, we're competing against global macros, the likes of which I don't think we have seen the convergence of in a very, very long time. Different vectors of risk, different vectors, certainly of opportunity, but the underlying narrative of uncertainty that is going to be persistent, creating confusion, clutter, disinformation, malinformation, a part of it. And within that environment, you have elections in Tanzania at the tail end of last year, which were interesting, given the LNG opportunities, $30 to $40 billion off the south coast of Tanzania, Lindi and Mtwara, which we hope comes to fruition. We have elections just completed in Uganda, which were, again, quite interesting. And that's the 15th of January. We have elections coming up in Ethiopia, which you just mentioned, as a growth engine on the 1st of June. And then as a Kenyan, from a long distance perspective, we have the golden run or in 2027 of the Kenyan elections. So there's a lot. In my professional life, I haven't seen, or professional civilian life, should I say, I haven't seen that complexity of competing interests. And within that, African nations are trying to get investment to feed and understand and grow and support the demographic, to turn that youthful population to a dividend as opposed to a crisis. And there is a lot going on there. So I pose that just as a starter for 10 in terms of setting the scene as to why it is important and vitally important we have this conversation regarding policy, regarding governance. Because in that environment of lack of policy, lack of governance, we then have competing opportunities elsewhere that aren't having to be underpinned by a lack of confidence and credibility regarding policy and governance to attract and retain and upskill and develop the investment that is required for the populations. And I draw attention to Southeast Asia and Vietnam, for example, where there is competition for capital and it's winning because the policy and governance procedures are in place, as an example, and elsewhere. So Africa, East Africa, needs to consider itself in that broader macro environment. Thank you very much.
Thanks so much, Hutch. Wow, what you said underscores the complexity of the conversation that we're having and how deep it could run with all of these competing factors and where that places East Africa in the context of the world, looking at unlocking this growth rate, which it is predicted to do. Let me move now to Hajila. Hajila, from your vantage point as a senior economist at Mauritius Central Bank, what are your thoughts on the macroeconomic and investment landscape in East Africa, looking in your crystal ball?
Thank you, Jason, and thank you, Invest Africa, for this opportunity to actually weigh in on this very interesting conversation around East Africa. I think one thing that is clear, and I think Hutch did a very good framing as to the context and in which East Africa is actually seeing itself against the global headwinds and as well as domestic issues. And I think for me, it's about looking beyond those headline growth figures. We are projecting East Africa to register the region itself to register above 6% growth. So what this tells investors is, despite, the elections happening and everything, I think what's important going forward for East Africa is that the macro story is going to be shaped not just by, one-off tailwind. It's going to be tied with economic integration and trade integration. This is what we are seeing. And there's a lot of momentum garnering around logistics and ports and transport, even around, crude pipelines. So I think when you think about the growth story for East Africa, I like to think of it as looking beyond the cyclical trends when you look at, different groups of countries. So for me, the one takeaway is that, it's about how East Africa is actually leveraging, its neighboring countries to actually build a story where you're going to see durable growth coming out.
Thanks, Sajida. So let me bounce back to Hutch and ask the following question. Given this macroeconomic context that Hajida has just given us, why does creating a credible investment ecosystem through governance matter more than ever for East African economies?
Thanks, Jason. Carrying from where Hajila left off, there isn't a shortage. I think the one lesson that I learned from the financial crisis and then from COVID and other global examples is that there isn't a shortage of capital globally. There has never really been a shortage of capital. There is a shortage of bandwidth and attention for markets to attract that capital. Capital is being described as a coward and will find cover and will find a location where it feels safest. And if you're competing for that capital, you've got to create an environment where that capital, the investors, the committees that surround it, the boards, are comfortable that an investment will survive and thrive and is scalable. And I think from an African government perspective, and there are a lot of people on this call, I'm sure, who have had deep technical expertise, deep technical engagement with African governments, is the perpetual question of, are our investments going to survive contact between administrations? What is it going to look like in 5 years' time, in 10 years' time? What is the rate of return? What is security on that rate of return? And governments need to put in their sweat equity. If they're expecting capital to arrive from the GCC in China and America and elsewhere, what is their sweat equity? Their sweat equity is the investment in policy and regulations and governance that make the investors feel and understand that they are going to be comfortable and secure in the tenure of investment. Typically, in this environment, there are a few things that investors consistently look out for. They're looking for the rule of law and the sanctity of contract. They're looking for security, both in terms of their people and their resources and their property. And finally, they're looking for human capital. That, is that a reliable pool of human capital? Or are there regulations to allow me to bring in human capital? That's it. That's what investors are after. And thereafter, they were willing to commit. And I think African governments in this environment, given the 10 or so things I mentioned earlier, are competing for bandwidth. And people who have a lack of appetite to persistently discount Africa this or increase Africa that, they want to know that it can be done, that there is security of tenure, and they can progress from there. And that's why it's so important, more so given where we are on the 20th of January 2026, given what we have to look forward to moving forwards into December and other months, the other quarters of 2026. And It's a difficult environment. It's a challenging environment. Just one other point. To my mind, this is a discussion about opportunity. Africa is a conversation about opportunity and unlocking opportunity and scaling opportunity. And that can be done if the groundwork is completed. And that's where we find ourselves today. Thank you.
Thanks, Hutch. So on that topic of opportunity, I alluded to it before, but our demographic dividend in East Africa is one such opportunity. Will this demographic dividend fuel transformation? Will it deepen fragility? How are you seeing it? And also, where can East Africa realistically create jobs at scale over the next 3 to 5 years. I see that as a major opportunity if we can get past that hurdle. Perhaps I could start with Hajila, and then Hutch, perhaps you can weigh in on that same question.
Yeah, sure. Like, I mean, come on, let's say, I mean, when we talk about demographic dividend, I mean, time and again, in different conferences, you would hear people talking about, it's important, Africa is going to host X billion amount of young population. But to the extent, I mean, the most important question is to the extent that government will be able to translate this demographic dividend into something tangible, right? Or is it going to sort of fuel more fragility in economies? And we've seen it, the youth are angry, and we've seen it in Madagascar, just right next door, when the young population is not happy, they'll make themselves heard. So this calls for important reforms and also investment in the right industry. So I think today, and let's be real here, so East African countries today are facing some of them. If you look at Kenya, they're sitting on big debt, right? And they are going to see themselves with a huge big opportunity for them to leverage their young population. But how they're going to do that is the question. So I think for me, there is space for them to do that. But it's about having partnerships and making sure that capital is being allocated in the right manner. There needs to be fiscal discipline, like if you're just throwing in money and it's not sustainable, then you'll have to back the door on those reforms. And obviously you won't be able to create jobs in a sustainable manner. So for me, really, if African governments want to actually capitalize on the demographic dividend, it's about being able to leverage partnerships with the private sector in in their key sectors where they have the competitive advantage. And for me, the agri sector is a clear winner. And Hutch rightly spoke about scalability. And I think there are little momentum that we're seeing in those sectors. In Kenya, they're leveraging technology to get new jobs. And I think more and more we're going to see those kind of initiatives and sort of momentum around the agribusiness as well as the logistic industry.
Thanks, Ajila. Hutch, what do you think about the demographic dividend and where jobs can be created at the sort of scale that's going to be needed over the next 3 to 5 years?
I think the last bit of that question is perhaps the most important, at the scale that's required over the next few years. I think that's the fundamental question. But I can just peel back to a couple of things that Jill has said. One regards discipline, and somebody somewhere that's in my dim past said discipline is the art of doing the necessary before it becomes urgent, right? And that is where we find ourselves, right? Probably. And that's where we find ourselves in terms of the urgency to do what is required, rather than having had the discipline to have done it earlier. So again, where are those areas of interest that the investors need attention in order to create a sense of scale for where they can absorb population, young population. The second bit regarding the demographic dividend, which is an aspiration, right? It's not where we are. There isn't necessarily a dividend right now. There could be a dividend that will come in the future. Like any investment, there are ups and there are downs. And I think from a Kenyan perspective, as a Kenyan, looking globally as well at the thematic of the Gen Z movement, globally, not just in Kenya, not just in Uganda, not just in Tanzania, but in Madagascar, in France, in Europe, in America as well, it is a momentum. But let me pair that back to East Africa, which I know reasonably well, and across Africa, which I know reasonably well. There is a question that the Gen Z, like any generation, are asking themselves about the ratio between aspiration and attainment. And we have stability in countries globally where the aspiration to attainment ratio is in balance. People aspire to do better than their parents, or to do well, given their investment into their education, etc., etc. Can they attain that? Who is attaining that, and how is it being attained legitimately? And where there isn't a return on that investment, where the Gen Z cannot see a return on their attainment relative to legitimate aspiration, we have instability. And so that is the question that I have for our governors and the governance and the policymakers is, how do you balance legitimate aspiration with creating an environment for investors to fill that aspiration? And if we don't get that, we have instability, and it won't be a dividend, Jason, I'm afraid to say. It really won't be. But where could it be? There are huge opportunities in value addition, but those value addition elements aren't in Rwanda doing it and in Kenya doing it and Uganda doing it. It's in grouping together of pools of opportunity in order to cluster pools of capital for investment. It is in mining and value addition in mining. And so it goes on. What do we have, and where can value be retained and up and created? Value addition happen within the shores of Africa, recognizing that BMW and Mercedes and BYD aren't going to produce a final component of their batteries in Zambia or in Zimbabwe or in Kenya or in DRC, but there's certainly an increase in value that can be created and maintained and absorbed within these jurisdictions. Last point, to what extent are governments thinking about creating value of their own as opposed to creating shareholding of value? So why can't the refinery for gold and rare earths be pooled together between countries as shareholders, as opposed to each country thinking it needs to have a critical national infrastructure of its own and compete with its neighbor as opposed to pooling that resource? I think therein lies the strategic opportunity for the region, for East Africa, is pooling together its resources, but more so pooling together the opportunity to accelerate the realization of those resources. Thanks.
That's a very thought-provoking point that you raise, the question of pooling those resources across the countries in the region. And that segues into one of our big topics for discussion today, and that is the regional integration agenda. It's often an enabler that we talk about converting growth into bankable investment. And perhaps I can turn to Hajila for Hajila. Could you give us your views on how effective East Africa's regional integration agenda is in lowering trade barriers and improving access to markets?
Okay. Well, I mean, if you look at the figures itself, when you talk about intra-trade in Africa, we often talk about it being at a very low, at 16%, and this, compares to, European counterparts. But if you look within the EAC, this is above the African continental average. It's around 28%. So it's still low, but I think if you think about the efforts that the EAC is putting into increasing intra-trade flows compared to the other regional blocks, then you can clearly see that there is momentum there from EAC members to actually increase intra-trade, and you actually see it. If you think about I like thinking about it along the value chain across different sectors. The EACOP, for instance, that's going to come live in October 2026. I think it's a big milestone. It's going to be a big milestone for Uganda and Tanzania, and it shows how the EAC members are actually trying to build those blocks in different countries. And for me, the EACOP is going to be what Dangote. I'm going to be bold in saying, the kind of importance and the kind of positive spillover that it's going to have on EAC in the East African region. And if you look at the amount of investment going into in the northern corridor, you have the GCC, you have DP World that signed a concession deal with Dar es Salaam port in Tanzania. So you're seeing increasingly, efforts in those areas. And I think we will see more and more. Like, they are slowly laying the groundwork. Let's not say that they're already there. But, there are small initiatives. There's the one-stop border post, looking into, reducing custom waiting times. So I think all these things are important, when as Hutch said, when investors are coming, they want that guarantee, that there are the other infrastructure around to actually enable them to sort of start doing business, right? And with industrial parks in Kenya. So for me, I think we are seeing positive and tangible progress around that, and I think. There is hope, but let's be mindful of the risk as well. Like it's still fragmented, right? And time and again on different, seminars, you hear people talking about, availability of FX being a major roadblock, and there is power is not reliable. Right. So you have those structural issues that are very inherent to different countries. So I think it's about how you come together as, different African governments coming together and actually looking at how, looking at growth, not just at national level, but also seeing it, more from an African perspective, and how they can work together and leverage on their resources to actually increase those regional integration. We talk about AFCFTA, but very few countries are actually trading on those terms.
Thanks, Fadila. That's very thought-provoking. Hutch, from the perspective of someone who advises investors that are looking at this region all the time, what would just stepping into the shoes of investors on this topic of regional integration and trade and connectivity, what would you advise your clients when it comes to making sure that there are investor-ready projects and where those investor-ready projects are? What are investors looking for when we talk about investment readiness, implementation, credibility? What are you seeing on the ground when you talk with investors and advise them on this?
Thanks, Jason. So the first thing that we talk to investors about is understanding two components. One is their center of gravity, and I'll describe what that is. And the second is understanding the state or the sector and the market center of gravity. So what is the center of gravity? The center of gravity is the key enablers, key requirements, and key dependencies. So key enablers, key requirements, key vulnerabilities of a strategy. So if you want to explore and grow your capability as a mining and extractive in Zimbabwe or in Kenya or in Tanzania, what are your key enablers, key vulnerabilities, and key requirements to succeed in that strategy? That's part one. And that generally relates to the rule of law, sanctity of contract, human capital, and security. That's it, right? I say that's it, and I'm not being unkind, but within that, there's a lot of detail. And then you ask the state, when you're having this discussion with the state regarding resource beneficiation, for example, as a primary concern for a lot of states across East and West Africa and Central Africa, is, okay, what are we getting out of this? And the demographic dividend or demographics are a huge part of that. So their center of gravity, their people, the economy, their FX, being able to scale investment. So these are the things that we are asking and trying to pair where that risk and reward is, where the opportunities lie, for a mutual sense of we share centers of gravity that allow us to explore opportunities together. I was speaking with a bank considering investing into East Africa last week, right? And due to the nature of the regulatory changes in this market, they see opportunity, but they see opportunity relative to a significant NLP problem. They see opportunity relative to a potential regarding SACCOs, which are huge, and there's a huge opportunity to unlock them and the memberships of these cooperatives. But the underpinning lack of governance, the lack of confidence in the rule of law to protect their investment is a concern. And I think that is where we need to spend some time as governments or with governments, in support of governments, to help them really understand the fidelity of the concerns of the private sector. The last bit, I think, regarding converting growth and potential into bank opportunities is, what is the role of domestic pools of capital? What is the role of the banks? What is the role of pensions? What is the role of the SACCOs, the cooperatives, which have huge pools of capital? And what is the role of insurance? Those pools of domestic capital married with international capital have a huge ability to leverage and play off each other for the ratio between patient capital and a return expected in a more demanding frame in terms of 5 to 7 to 10 years. And that blend of capital is fundamentally at the center of how we can move the dial forwards. But again, in terms of bankability, it's the basics. Is there an environment that captures and enables and supports investors to understand and appreciate that they are the fundamentals there, the rule of law, the sanctity of contract, the security, to enable them to succeed?
So that's how you'd advise your clients looking forward. Let's pause for a moment and look in our rearview mirror for a second. Can you think of successful examples of collaborations between governments, DFIs, private investors in the East African region? For example, a couple of years ago, I worked on the roads annuity program in Kenya, which I think was successful. We saw Standard Bank lending into projects of Mata Angel as a project sponsor in developing a number of roads lots around Kenya for roads upgrades, which to my mind have had a profound effect on the mobility of human beings and the flow of trade inside Kenya. So I think that's one example of something successful. A while ago, I also worked on some small hydros in Uganda, where US DFC funded these small hydro projects, and that unlocked some additional renewable energy. Perhaps first Hutch and then Hajila, can you think of really great examples of successful collaborations where private investors have come in and they've scored?
Yeah, sure. I think there's some within East Africa. We look at e-mobility and how e-mobility has scaled. It has scaled as a result of the nature of the government understanding the opportunity, with private investors understanding the scale of that opportunity in terms of young people on bikes, for example, on motorcycles, and that e-mobility platform now being unlocked and the significant opportunity around that. We have seen it again regarding energy. So yes, within solar, within hydro, as you've mentioned, we've seen some great examples there of where the governments have worked collaboratively. Yet there is still a challenge regarding the last mile for lower income families. And that by and large, hasn't happened as of yet. So there continues to be a challenge. I think we've seen some really interesting examples regarding ports and logistics, where there is an opportunity to unlock, there has been an opportunity to unlock and increase efficiencies around the ports in Dar es Salaam and to a certain extent in Mombasa as well. But there's far more to be done there. What is going to happen in Berbera? How is that going to be unlocked, et cetera, et cetera? So I think there are huge opportunities there. And most recently, of course, the announcement in Ethiopia with a new airport.
The airport.
Huge, significant opportunity, which I think is going to catalyze a lot of growth, significant amount of growth, if they can get that balance right between the EIH, the Ethiopian Investment Holdings, the Ethiopian government, the African Development Bank, and private investors who are going to participate in that. Huge, significant opportunity there. So there are pockets of that. I think the one question I would leave is, where are the pockets of regional integration, of catalyzing growth at a regional level? And those are smaller, Jason, at the moment. And I think that's perhaps where we need to spend more attention as well, is regarding how can we pool that capital for those resources and opportunities.
I love that answer. A combination of looking in your rearview mirror at what's worked, but also opportunities that are clear and present and actually happening right now. So thanks for that. What about you, Hajila? Looking in your rearview mirror, do you have any examples of successful collaborations, successful investments by private sector investors in the region?
I think Hutch covered most of them, I'm going to be honest.
Yeah.
And, like he literally just listed the whole, like taking on from Tanzania to Kenya. Well, I think just to wrap it on both what you both said, there are clear examples, right? There are examples. And I think for me personally, when I look at it, more and more we're going to see those kind of collaboration. And for me, I like I like the concept of concession deals, when you look at long-term projects for governments. And I think looking forward, these are the kind of things that we're going to see increasingly, and maybe blended financing for, more strategic sort of projects around minerals, mining. So that's the kind of framing that I see things moving forward. But I think both you and Hutch did a very good example to just exhaust that list.
Excellent. Well, another question for you then on a slightly different tack. You're at MCB, you're a banker, you do a lot of research, and questions come up when thinking about investment in East Africa on how to mitigate risks, how you manage debt, how you manage fiscal pressures, how you manage currency risks. I'd be very keen on your perspectives on what you're seeing in your research and in your work every day around that topic.
All right. So, for us at the moment, if we were to have like a watch list of countries that are kindly at the moment that we're watching keenly, it's Kenya. Kenya, 2 years ago, there was a lot of fears around whether they're going to default on their Eurobond. But, they were successful in tapping the market, and we saw them raising a Eurobond. And last year in October, they were able to convert their part of their Chinese loan in away, from US denominated debt to yuan. So I think for us, Kenya is the one country to watch when you think about debt. There are good things happening in Kenya. We've seen the government increasingly leveraging liability management operations, and they're trying to look for different financing options to sort of maneuver around their fiscal situation at the moment. And the problem is very often what many African governments faced with is that they have to backpedal on certain reforms. They are important. And with Kenya's fate, they had to stop their IMF program, because they were not able to sort of onboard the reforms. They had protests. So I think today it's not just Kenya, even for Mauritius, we face today, like, it's our fiscal situation warrants attention, and the government's doing everything they can. We talk about more targeted reforms. You can't be paying pensions and then all of a sudden you stop cutting pensions. That's not something that you can just do overnight. So what I think for Kenya, right, is for this year we most probably going to see them tapping market again, so as to manage their big amortization that's going to come in the next 2 years. So for the moment, if you think about Kenya, so I think default risk is on the low side, but obviously I don't see them unlocking their IMF program anytime soon. It's probably going to be after the elections, so that there's some policy continuity. And another aspect, I think, with Tanzania, with a lot of, those political temperature, with Uganda and Tanzania, I think what is important for investors when they are, gauging the risk around those countries is that, Tanzania last year, there was a lot of oppression, and we saw World Bank actually suspending their funds. Right? No, not World Bank, but the European partners actually suspending aid. But so that's like a precursor. If you think about what happened in Uganda, just last year, the World Bank said, okay, we're going to reactivate and freeze some of those loans. But this puts a big question as to the extent that African governments, especially where you see their election cycles coming in and there's a lot of frustration, how are governments going to sort of maneuver around that? So for me, most importantly, if there's one message, how should government manage the debt? Prioritization is key. Know where you can invest and where you can't invest. Diplomacy is going to play a big game today. And, we are seeing Africa sits today, has leverage. Everybody's eyeing Africa's potential. So if you look at East Africa, as a government, you know your leverage, you know where you can sit between this power game. And I think diplomacy, getting concessional lines will be the way forward for them to better manage the debt. And I like to think about Maldives. Maldives is very close to India, and they're also in high debt distress, but they're able to sort of roll the lines and get the kind of funding that they need on a more concessional basis to sort of walk around their debt problems. So I think for African governments, it's going to be the same. PPP. You need partnerships with private sector. Know how you're going to invest, and move away from the traditional way of raising capital if you need to fund important projects. So yeah.
Amazing. Thank you very much, Ajila. So at this juncture, I noticed that there are 5 very juicy questions in the Q&A. We're quarter to the top of the hour, and a 6th one just popped in as we speak. I think this is a good moment to work through the questions from the attendees, and we can work out who's best placed to answer each one of these questions. And that hopefully will lead us very neatly to just before the top of the hour, just from a time management perspective. So the first question that came up is, do elections meaningfully delay investment decisions, or have investors learned to work around them in this region? Obviously highly topical. We just saw an election a couple of days ago in Uganda, and there are lots of elections coming up. Perhaps Hutch, that's a question for you to kick off with. And Ajila, if you've got anything to add in response to that question, you can do so.
Investors have learned to work around elections where they see that the scale of investment and the rate of return of that investment warrants their patience. Is probably the most diplomatic way I can answer that question. I can give you an example in a few years ago in Zimbabwe, where I was in the room where a multi-million-dollar deal was being considered, where funding was in place, and all they're waiting for was for the election monitoring committee to say that the elections weren't perfect, but they were adequate. And that investment, that capital would have flowed into Zimbabwe. Unfortunately, a corporal in the police decided to shoot 6 protesters, and that deal disappeared. That's a few years ago. We have seen in Tanzania the elections and the disruption caused by elections, but Equinor hasn't gone anywhere, nor has Exxon, nor has Shell, because of the scale of the opportunity in Lindi and Mtwara and the nature of that opportunity. So I think it does depend. For members on this call who have been operating in and around Africa and East Africa for some time, I think they have the answer in terms of what is the rate of return, what is the nature of that return, what is the degree of patience need to be executed in order to develop that opportunity. And that will then justify if they're willing to wait or not, stick or twist.
Yeah. Ajila, did you have anything to add to that response?
Well, I think, Mozambique with ExxonMobil's decision, putting a force majeure because of instability there. So I think, there are some cases where, we've seen, forget election, but instability sort of, being a big hurdle to projects. So, but they're back online, end of December, they're back. So they're hoping to sort of conclude their final investment decision by early this year. So I think, yes, their insurgencies and elections could sort of delay investment, but you have examples where, you wait and see when it's the opportune time for you to come back.
Yeah, that makes perfect sense. Second question. Following up on Ms. Padachi's comments, any thought on how stablecoin settlement adoption may ease the common payments hurdle to inter-country trade volumes in the African CTA, the free trade agreement? I think I know who that question's from. Ajila, have you got comments on that stablecoin settlement?
Look, I think this takes me back to one of the first comments that Hutch made at the beginning. It's around regulatory clarity, right? So, we talk about Bitcoin, stablecoin, but, the big question mark here today, if we think about the AFCFTA, right, there's been some good initiatives with the PAPs, but it's still very fragmented. So for me, to the extent how stable, I think it will take time, for it to sort of counter that hurdle when we talk about inter-country trade volumes. But for me, beyond, when we talk about, obviously FX availability is a big issue in many African countries. But for me, for be it any sort of settlement platforms that you can have, what's important is you need investors to trust, the architecture around it, and there needs to be really clear rules around that for it to sort of actually unlock the benefit that you would hope for it. I don't know if Hutch would like to add anything on that.
I think you've hit the nail on the head. It's, my old boss would say, credibility buys you freedom, right? So what is underpinning the stable coin to make it a credible method and mechanism for adoption, right? For settlement adoption. Is it credible? Is the governance structure credible in order for that to happen? It's a huge, huge opportunity, right? But how can this happen? I just think one other point, Hajili, you mentioned earlier regarding innovation and financing. I think part of that conversation also relates to something like tokenization. Where is a significant opportunity related to tokenization that governments could adopt, that the private sector wants, in order to have a stake in large infrastructure projects, large extractive projects? There is a huge amount of opportunity there, but it's poorly understood, and there's more work to be done perhaps by the private sector, but also from a governance perspective to adopt that sort of innovative financing model. So yeah, a couple of answers there. Thanks.
I see a comment popped in at the bottom, USD pegged stablecoin. Does that make a difference to your responses in any way? Okay.
Well,
so then, yeah, carry on.
That's good. It is USD pegged in any case.
Yeah. Okay. Then there are two questions that I think we've dealt with already in the context of this discussion. What's the biggest difference between EA countries that attract repeat capital and those that don't? I think we have touched on that in our discussion. Another question, which sectors can realistically absorb large numbers of young workers in the next 5 years? I think we unpacked that also earlier on in our discussion. So I'm going to move on to the next question. Thanks for the session. Great insights shared. Great compliment. Thank you. The EA region has seen an increased move to mobilize more domestic capital, with pension funds, banks, and insurers sought to be catalytic players in these efforts. Where should domestic capital be mobilized over the next 3 years to unlock economic development and job creation while maintaining fiduciary duty? Hajila, any thoughts on that from the banker's perspective?
Well, I think we've touched on a couple of things already. For me, where I see like the sectors where domestic capital will be mobilized actually for East Africa will be around, logistic and transport corridors. For me, that's like my one message, for investors that's looking at East Africa. And for them to me, and with regards to job creation, I think in terms of scalability, for me, it's agriculture. And agriculture, as you at the very beginning of the session, you mentioned about how important agriculture is to many of those East African regions. And I think there are little initiatives. You have Twiga Food in Kenya, where you're able to connect farmers with vendors. More and more, I think these are the kind of you innovate, and you make sure that you're not looking at agriculture in the traditional way that it is, and we are actually seeing that happening. And for me, in terms of job creation, that's the sector that will potentially be able to absorb the young generation.
Thanks, Hajila. That's very insightful. Hash, anything to add to Hajila's answer around where domestic capital should be mobilized to unlock job creation?
It was a bloody good answer, but I just add a little bit more regarding architecture. I think there's a conversation to be had between pension banks, insurers, and governments regarding what is the architecture that we need to scale broader investment into a region. Logistics, energy, the cost of energy in countries. Those are areas where A, there'll be a rate of return, B, there's a requirement for large levels of investment. I think on that list of pensions, bank, insurers, these are large pools of domestic capital. From a Kenyan perspective, there's a third one or fourth one that should be on that list, which is SACCOs, right? The cooperatives which pool informally / formally, regulated and slightly unregulated, lots of memberships of these cooperatives that can get a rate of return if they are stakeholders in large infrastructure projects. That could be really interesting. And then I come back to things like tokenization, which allow fractionalized ownership, in inverted commas, of assets. That could be really interesting. So I think there's a joining the left hand to the right hand and having a coherent understanding of where we're trying to get to would be very helpful in being able to then identify where capital can be deployed.
Thanks, Hutch. Brilliant. There's another question which I think we've possibly answered already, but I'm going to throw it out to you as panelists anyway. The question is, there's a school of thought that capital is not the challenge, but where to deploy this capital. Where are the key opportunities in East Africa that are investor ready? Hutch, you sort of rattled off a list earlier on of some investor ready projects and areas. Would you like to do a short recap for purposes of that question?
Sure, I completely agree. Capital is not the problem. It's where it's going to be deployed, right? The choices are there. So in infrastructure, significant levels of opportunity in ports, significant amounts of opportunity in rail, significant amount of opportunities in roads, of course, and these connecting resources to the market. So those are significant. Fintech, a large amount of opportunity to move capital internally, but also to get it to where it is needed from a B2B, B2C perspective. Huge opportunities. Hospitality, what are we doing there? Huge opportunity also regarding resilience from an agriculture and from a hospitality perspective, investing in the resilience of those aspects, particularly related to climate fragility. So I think there's something to be said there. We haven't discussed climate fragility, but given where we are geographically, there is a lot of invitation, there's a lot of appetite to invest in those sorts of opportunities as well. So rather than rehashing the old list, perhaps I'll add a couple of new things to that list and for people to consider. But yeah, huge areas of opportunity.
Adila, I'm not going to ask you to comment on that one. We're 2 minutes to the top of the hour and there's one more question. I see George has switched on his camera. George, are we at liberty to look at that last question, or would you like to wrap it up?
No, please take that last question.
Okay, so the question from Paul M. How would you advise a utility-scale wind-led project in Kenya that is at PPA negotiation stage off the back of the lifting of a moratorium on PPAs introduced 7 years ago to deal with the rising cost of electricity tied to politically exposed persons securing PPAs at absurd tariffs? That has thrown off the supply-demand dynamic in the face of the National Treasury backpedaling on the requisite letters of comfort required to ensure any PPA with a public off-taker remains bankable. Project cost about $200 million. Adila, any thoughts? I see you're smiling. Are you smiling because it's a very, very difficult question, or are you smiling because you know the exact answer?
I'm just thinking that Hutch would be the better person to answer that question.
Hutch, what are your thoughts? How would you advise a utility-scale wind-led project?
I don't know if you ever played rugby, but that's called a hospital pass. But thank you so much. I'll take it. I'd ask the question, how far along are you in this conversation? I'd ask the question, I know it's the project cost of 200 million, but how far along are you in that area? Capital is mobile. I know Paul M knows this, but why are you fixed to Kenya? What is the likelihood, given your timeline for investment, for that to be resolved in a period of time where you think makes sense? And to what extent can you put to the authorities, this is the investment, these are the advantages. This is how it links to your center of gravity as administration. But this is what we are going to do if we can't reach a reasonable settlement. And I think investors can't wait for governments to come to them with a perfect understanding of their requirements. Or, let's frame it in a slightly different way, governments and individuals know exactly which buttons to press. And the question is, how do you press buttons back and move your capital? I am a Kenyan. I am loyal to my country, but I'm also far more loyal to the people of Africa than to an individual country. And therefore, where is that investment? Where could it find a better home? And if it's not going to be in Kenya, and I say that sadly, where is going to be a better home for that investment? And maybe through that mobilization of capital and the loss of that opportunity, heads will turn and say, okay, on the next turn of the handle, we will do this in a slightly different way.
Thanks so much, Hutch. I could tell that you advised that with a heavy heart. George, we're at the top of the hour. Would you like to jump in?
Yeah, thank you very much, Jason, and thank you for your expert moderation of this session today. I'd like to express a thanks to Hajila and Hutch as well. I mean, really, really fascinating session, and obviously a hugely important outlook for those who joined the call. Hutch, you mentioned the word uncertainty at the beginning, and we're seeing that across the globe, and you gave the examples. I think it'd be interesting to see how the region's resilience sort of performs throughout the year, and I think the sort of key examples that both you and Hajila provided really valuable and really interesting. So I know that everyone who joined today will have taken a lot from the session. So hugely appreciated. For those who maybe joined halfway through or might have missed some of the session, we have recorded this. We will be posting it on our YouTube channel and our Spotify. So please just keep an eye on our LinkedIn for those links. Later in the week on Thursday at the same time, we will be hosting our West Africa Outlook. And then next week, Tuesday, we'll be looking at Central Africa as well to wrap up our African regional outlooks. So please do keep an eye out. We'll also be in Cape Town alongside the Mining Indaba, as I'm sure many of you will be as well. So we're running our 13th annual mining series with about 8 events. Please do get in touch with us or have a look on our website for more information. It'd be fantastic to welcome all of you. But with that, I will close. Jason, Hajila, Hutch, thank you so much for your time today. Really interesting. And thank you all who joined. Thanks very much.
Thank you. Take care. Bye.